The forthcoming meeting of the Reserve Bank's Monetary Policy Committee on October 3rd and 4th is by far the most crucial since the constitution of this committee. With India's gross value added coming in at 5.6% for 2 quarters in a row, the committee for the first time is faced with a genuine growth versus inflation dilemma. With this preface, let me welcome CNBC TV 18's Citizens Monetary Policy Committee to debate this very same dilemma. I welcome Chairman Pranab Sen and members Samran Chakrabarti, Soumya Kanti Ghosh and Sajid Chinoy, as well Sonal Verma. Gentlemen and lady, welcome. As always, our committee meets on the eve of the Reserve Bank's MPC meet to educate us on what we may expect from the Reserve Bank. Well, let me start with you, Dr. Sen. The growth issue is serious, yet the MPC's mandate is inflation at 4%. What do you think the committee should do? Should it sympathize with growth?
Well, I think things have changed. The working capital pressures have now become so acute. It's going to go away, certainly, but it is acute now, and if it's allowed to persist for an extended period of time, you're going to see serious supply-side issues cropping up. And this is a time when I think the way you think about inflation has to change a little bit. And you really need to start thinking about encouraging short-term production.
Okay, that point...
Not necessarily a demand-side effect.
Point taken, sir. And I'll take that straight away to the banker here, in the sense, the commercial banker, Soumya. Soumya, if there is indeed a rate cut, how will it impact banks?
See, as of now, I think the central bank is actually targeting a 4% inflation rate. And if I just digress a bit and look into the inflation trends, the numbers, the monsoon, there is a 23% shortfall in rainfall in UP, MP, Haryana and Punjab. So that is already impacting the cereal and the pulses production. We are seeing that the prices are going up. So I think the inflation numbers could be look a little bit already in the next couple of months. Maybe a closer to 5% number by March could be an eventuality if the trend continues. So under the current circumstances, I think if the RBI is seriously considering 4% inflation target, it will be very difficult for them to cut rates immediately. However, having said that, I think the growth remains weak. If you look into the credit numbers, the deposit numbers, even though the incremental credit has actually improved from a decline of minus 2 lakh crores to around 70,000 crore decline, the deposits have also started to decline, even though it comes over a higher base last year. But my sense is that given the fact that deposits are weak, credits are also weak, the banks will also, and there is also a little bit of flight of shift to the time deposits from the CASA, because as you know, the CASA was at a very high level, so that's a natural phenomenon that it should move to time deposits. So if it moves to time deposits, and if that is the trend which is continuing, there has been a significant increase in the time deposits from April to September.
So margins under trouble.
So margins under trouble. So that will mean that the banks may have to go for a cut in deposit rates or otherwise, or lending rates, whatever may be. So that is actually going to be a very challenging situation.
So in that context, if there is a rate cut, because of the problems that Dr. Sen is alluding to, working capital problems, banks could be under further trouble, is it?
Banks could be actually under trouble in the sense that if the flight of safety to time deposits continues, even because the liquidity is still at a plenty, even though it has declined significantly from March levels. So that would actually put pressure on the banks to cut deposit rates. And in a country like India, where already the social pressures are often a little bit higher interest at deposit rates, as we can see are coming in the press, is a little bit difficult to manage. So I think this could be a little bit challenge on the part of the banks to cut deposit rates further from the current levels.
Okay, so now we have 2 points on the table. Working capital requirements of industry because of the short-term problem may merit a rate cut, is what Dr. Sen is saying, or easier liquidity conditions. But you are saying for the banks to pass it on looks well nigh impossible. It could be a wasted rate cut.
I'll not say impossible, but also it will be a little bit of challenge to manage both the sides.
Fair point. But I think the fisc is the one that's the elephant in the room. Sajid, it looks like there will be fiscal slippage even without a fiscal stimulus. How should the MPC look at this? First of all, your estimates.
Yeah, well, let's just step back for a second, Lata. I think a couple of very important things have happened in the last few months. Growth has clearly slowed, but that's not the puzzle. The puzzle is, even as growth has slowed, India's current account deficit has quadrupled. And the only way these things can happen is if you believe there's some kind of negative supply shock in the economy after demonetization, where supply chains have been impacted and you've temporarily importing much more. Manufacturing imports are growing at 25% over the last 6-7 months. So the dilemma for the RBI is, on the one hand, this is a weaker economy for all the reasons Dr. Sen mentioned. Maybe some policy support is needed, but look at what's happening more generally. You've got a wider current account deficit. The rupee is under, like all other emerging markets, under a little bit of pressure. US monetary conditions around the world have tightened. Oil is up 10%. And you've got some risk here that you could have some fiscal slippage, which could be, again, transitory, but real for this year. That puts the RBI in a very delicate spot. It's not clear how central banks should respond to adverse supply shocks that both push down activity and push up either inflation or external imbalances. I would think, given the uncertainty, you wait it out for now. The beauty of their framework is all of this has to collapse into inflation. And if inflation is close to the 4% number without HRA, which they will look through, then the possibility down the line of modest support would still exist. Right now, given all the moving pieces, the fiscal, oil, the current account, the rupee, global financial conditions, despite what's happening on the growth front, it's prudent to wait it out.
Okay. Samiran, toss to you then. Growth is in crying demand of help, crying need of help. And I think for the first time, I'm seeing the political authorities genuinely getting worried about growth. Do you think the MPC can withstand that pressure? Should it withstand that pressure?
Yeah, as Sajid mentioned, the critical component for MPC is threefold. It has to first decide on, in their objective function of flexible inflation targeting, how much weight should be there on the word flexible. So keeping the growth objective in mind, how much of that weight the committee should put. The second is that, is it a cyclical demand side slowdown or is it a supply shock? Primarily because a lot of this anti-corruption measures taken through demonetization, GST, RERA, etc., that's creating a different kind of headwind to growth. So if it is more of supply side and less of demand side, then maybe monetary policy might not be the best instrument. And third is that this is typically an RBI's long-standing view that the effect of interest rate on investments is very low in India. In any case, we know in theory also that monetary policy works with long and variable lags. So is it the right instrument to stimulate growth at this juncture? So I think all these three issues will determine whether the RBI MPC is able to withstand the pressure from the political system, which is asking for rate cuts.
Okay. I will come back to you on this issue. Let me get preliminary thoughts from Sonal as well. Sonal, the bigger issue also is the rupee and the external situation, as Sajid explained. We are seeing already pressure on the rupee. Therefore, is this the right time at all for the MPC to extend a shoulder to growth? Should it cut at all at a time when the external situation looks wobbly?
Yeah, Lata, I mean, every policy decision, cost-benefit analysis needs to be done. And one, I think clearly growth is a concern, but we need to identify what is leading to the growth slowdown and whether monetary policy support will actually bring the kind of sustainable growth recovery in terms of driving private investment up or not. And the answer seems to be more that non-monetary factors are driving it. Second is the outlook on inflation. We've seen, food production estimates for this year are lower. Oil is up. Currency is higher. Fiscal risk slippage, are on the table now. So the risks around more sort of supply side shocks leading to some risk, I think they are very much on the table now. And core inflation has surprised on the upside in the last 2 months, even if you exclude the HRA component. Partly because of GST. And third, the other factors that Sajid was also talking about. I think India in the last 3 years has been seen as this beacon of stability in that we have taken a policy preference of macro stability over growth. And with a slight hint of fiscal stimulus, we've seen investors actually sort of slightly get panicky, and we've seen the impact on the currency side, we've seen the impact on the bond yields front, and we have a global backdrop of higher commodity prices and the G3 monetary policy normalization. So if the growth slowdown is a concern, but can it be supported through monetary stimulus, the inflation and the other backdrop, I think the risk reward at this stage actually suggests status quo. Going forward, depending on how things pan out, decisions will be taken. But the other thing I'd want to point out is that, we need to be forward-looking. We cannot be looking at, the last 6 months of data where we have seen disruptions on supply chain because of GST and because of demonetization. And if you look at the incremental numbers that are coming out for July, August, are suggesting that some of the consumption-related sectors, some of the transportation services-related sectors are starting to pick up. So the sectors that were hindered because of, cash or because of GST seem to be coming back. And whereas sectors which have been hindered because of more, I wouldn't call it structural bottlenecks, but because of, balance sheet issues are still quite weak. So the forward-looking indicators are suggesting that there will be a cyclical recovery led by consumption-driven sectors, again, not investments, and which is where we need to think about the broader policy options on the table.
Okay.
Monetary policy, possibly not at this stage.
Okay. Well, I have just come from a discussion with the top-rung capital goods maker, a mid-cap capital goods maker, and an SME, MSME set of capital goods guys, and they don't see normalcy returning till March to their working capital problems. Well, Dr. Sen, you get a chance to once again look at the growth inflation dynamics. You showed your sympathies to growth and to the working capital pressures, but fiscal slippage is imminent. Prices may rise more than what people had budgeted for, the MPC had budgeted for. As well, we were priding on our strong macros. Do we want to spoil them?
Well, let me put it this way. There are, I think, two issues out here. One is, until now, we have believed that the growth slowdown was essentially a demand-side problem. That's changed. It's now become a supply-side problem. As far as investments are concerned, that's not my current concern. My current concern is production. We have enough capacity available, and if the demand side picks up, as Sonal is suggesting that it may, you don't want that to get derailed because the producers are unable to actually produce the products. I think that's the dilemma. Because if you have a situation where, because of, let's say, working capital requirements are not being met, the producers are not being able to meet a demand, you're looking at inflationary pressure again. So it's not that this is entirely a trade-off. I think the two can actually feed into each other. And then on the other hand, you've got the declining rupee. You've got stronger, global commodity prices. Now, those are going to be feeding in. So one of the issues that the MPC really has to take into account, that are you going to stick to the 4% target? Or are circumstances unusual enough for you to say that we will stay within the band, but we are not fixated on the 4%? This is a call that they are going to have to take.
Okay. Well, the debate is definitely hotting up. Gentlemen and lady, we have to take a very quick break. We are back in a jiffy and continuing this all-important discussion, not just the dilemma between growth and inflation, but also the dilemma between fiscal and monetary loosening. Back in a minute.